Welcome to the deep dive. Today, we're going to try and decode one of the sharpest market disconnects I think we've seen all year.
It's a big one.
Yeah, and on one hand, you've got the trading boards just blazing green. It's pure optimism. We're seeing these classic risk-back-on sessions, especially in tech.
Right.
But then you look at the reality on the ground, the actual pulse of the American consumer, and, well, the data is telling a much, much darker story.
And that tension, that's really the core of it, isn't it? This great divergence is what's driving, I think, a lot of decisions right now.
Absolutely.
We're seeing these huge, very specific gains, mostly in U.S. tech and, some healthcare names. That's investor confidence just flooding into assets that promise future growth.
But the retail sector?
A completely different story. The mood there is defensive. I mean, they're relying so heavily on just painful promotions to keep inventory moving.
So how do we square that Wall Street euphoria versus, I guess, Main Street exhaustion? That's what we're going to unpack today. We'll look at why the consumer is so strained. And then we're going to uncover 5, I think, genuinely surprising shifts happening just beneath the headlines. We're going from a 30-year low in housing. Yes, we're back to the Macarena era.
I like that, the Macarena era.
All the way to a critical new investment theme in quantum computing. So let's start with the numbers that really define this divergence.
The market momentum is, well, it's undeniable. This risk back on feeling is incredibly powerful.
You see it in the indices.
For sure. The S&P 500 recently climbed, 1.38%? And it was led, as it so often is, by tech. The Nasdaq just roared ahead, up 2.35%.
And that's not just a small bounce. That's conviction money moving in. It suggests a lot of investors think the worst of the cycle is, behind us.
Exactly.
And when money flows into risk, it has to flow out of somewhere else. We see that so clearly in commodities.
Oh, absolutely. Crude oil took a pretty substantial dip, down about 2.45%.
And what does that move tell you?
Well, it suggests one of two things. Either supply is finally normalizing or, and this is the more troubling part, traders are forecasting a real slowdown in global demand.
Right. And gold.
Gold is just sort of quietly holding its own, up a little bit, doing its job as that insurance leg in a portfolio. But the real action, the focus, is clearly on high-growth equities.
It's a very split environment. Growth now, insurance later.
That's a good way to put it.
But the second you switch from looking at indices to looking at the consumer, the whole narrative just flips.
It completely changes. The overwhelming feedback we're hearing from all these corporate earnings calls is that the American shopper is, and this is a great phrase, tired rather than exuberant.
That phrase just nails it, doesn't it?
It really does. It's not that people have stopped spending. They haven't. It's that every single dollar is now being scrutinized. They're buying what they need.
Essentials.
Strictly essentials. Groceries, specific needs. And they're putting off anything that feels non-essential. They're just hunting for value with this surgical focus.
And we saw this in the Walmart report. The headline number, pretty solid.
It did, but the growth came with some major asterisks. It was heavily skewed toward groceries, which are, lower margin to begin with.
But the real kicker was who was driving that growth.
That was the nugget. It wasn't just low-income shoppers. We saw a huge influx of upper-income customers. We're talking households earning 6 figures.
And they're going to Walmart?
They're actively migrating to Walmart, specifically for necessities, specifically to find better prices. And that tells you that the cumulative inflation we've seen has finally started to strain even the financially resilient households.
So the weakness is broadening out. It's not just a story about the bottom half anymore.
Not at all.
If you have mid and upper income folks feeling the pinch and heading to discounters, that just totally changes the game for high-end retail, for department stores.
It does. Sentiment surveys are near historic lows. And you hear the management teams, Home Depot, Target, you name it, they're all saying the same thing. Softer traffic, selective buying, and this deep, deep reliance on promotions.
Which gets us to the financial impact. Forecasts say holiday sales might still cross $1 trillion, which sounds great.
Sounds huge.
But what is that growth actually built on?
It's built on discounts. The real damage won't show up in that nominal sales line. You're going to see it in the margin pressure.
Right.
Retailers are just compromising their own profitability to hit those targets. And for you as an investor, that creates a really clear choice. You have to own businesses with real pricing power or
the ones with massive scales.
Exactly. The off-price chains, the ones who can absorb these discounts and still turn a profit.
It's the profit story, not the revenue story. That's where the pain is. Okay, let's go deeper. Let's look at 5 specific stories shaping things. In story 1, it takes us to the housing market.
And we've hit a pretty remarkable milestone here. Existing U.S. home transactions, that they're at a 30-year low.
A 30-year low. We are literally back to 1995 activity levels. The Macarena era, as we said.
The Macarena era of housing, exactly.
It's a staggering comparison. So why is the market so completely frozen?
It's what economists call a two-sided lock. Supply and demand are both just stuck.
Okay, break that down. Demand side first.
On the demand side, buyers are just struggling. You have mortgage rates that are still elevated, near 7%, combined with prices that are near record highs. So for a huge chunk of first-time buyers, qualifying is just, it's out of reach.
And the supply side is just as paralyzed.
Just as paralyzed. The existing homeowner is locked in. Something like 80% of U.S. mortgages are cheap fixed-rate loans. 3%, 4%.
So they can't afford to move.
Why would they? If they sell, they lose that incredible cheap debt and have to finance their next home at 7%. The incentive to move, to upgrade, it's just gone.
So what's the takeaway for an investor here? It's more than just bad news for home builders, right?
Oh, much more. A quiet housing market casts a huge shadow over all these downstream sectors. If people aren't moving, they're not buying new appliances, new furniture, they're not doing big remodels.
It connects right back to that retail stress.
Directly. And on the flip side, this whole dynamic really benefits the rental market. It boosts apartment rates because people are forced to rent for longer, and it could even help specialized suppliers who focus on necessary repairs, not the big optional renovations.
Fascinating. Okay, let's shift gears. Story number 2. The quiet outperformer. Everyone's obsessed with big tech, but the healthcare sector has been incredibly resilient.
Yeah, what's so interesting is that the S&P Healthcare Index has been enjoying this sustained outperformance, up mid-single digits for the month, led by big drug makers, some strong biotech names. It's not flashy, but it's a very smart rotation.
And what are investors looking for when they make that rotation into healthcare right now?
They're looking for what you'd call earnings resilience. The big question investors are asking is, have tech valuations already priced in or sort of front-loaded several years of AI growth?
So they're getting nervous about the hype.
A little bit. And by contrast, you have a lot of high-quality pharma names that are still trading at a discount, but they offer predictable demand that's driven by demographics and stable drug pipelines. It's almost a risk-off trade within the equity market itself.
Moving from cyclical speculation to structural necessity. I like that. Okay, story 3 is where we get to the elephant in the room, the risk check.
And this is the data point that should really make any disciplined investor just pause.
Which is?
We've seen margin loans, that's money borrowed against your investments, cross $1 trillion for the first time.
$1 trillion. And this leverage is being added after a huge run-up in the S&P 500.
Exactly. Investors are pouring gasoline on an already burning fire.
So what happens if the market corrects when leverage is this high?
Well, that's the real danger. Leverage amplifies everything. It amplifies gains, but it also massively amplifies losses. If prices fall too fast, you get a margin call.
A demand for more cash.
A demand for more cash, or to sell assets immediately. And when that happens, high-margin debt creates forced sellers during a downturn, which just accelerates the whole decline. It's systemic risk.
And yet, on the complete other side of that coin, you have the most disciplined capital allocator in the world, Berkshire Hathaway.
Sitting on a record cash pile, over $380 billion.
That's not just cash. That's strategic optionality.
It's the ultimate tension, isn't it? On one side, you have high leverage chasing a rally. On the other, these vast disciplined reserves just waiting. And that brings up a very important question for you, the listener. Where is your own portfolio positioned?
Are you running into strengths with everyone else?
Or are you prioritizing that optionality, that dry powder, waiting for the mispricing that a sharp correction could bring?
Very stark contrast. Okay, let's jump to story 4. This one involves a threat that sounds like science fiction, but it's already driving millions in corporate spending. Quantum computing.
Right. Post-quantum cryptography has gone from being this theoretical idea to a really active and necessary investment theme. The threat is pretty simple, actually.
Which is that quantum computers will be able to break our current encryption.
Essentially, yes. When scalable quantum computers arrive, they'll make a lot of the standards we rely on for banking, for commerce, for everything totally vulnerable.
That's a huge systemic risk. So if the tech isn't quite here yet, why is it an investment theme today?
Because the transition to quantum-safe protocols takes years, especially for these huge decentralized systems. So companies like Cloudflare, which is basically the security layer of the web, or Pure Storage, or even the big payment networks like MasterCard and Visa, they're already investing heavily.
So what's the specific investment thesis?
You're investing in structural necessity and first-mover advantage. These companies are building and setting the new global standards. By being the architects, they lock in these long-term customer relationships that are based on protecting against a future systemic threat.
It's the intersection of cybersecurity, cloud infrastructure, and, I guess, standard setting.
That's the sweet spot.
All right, our fifth and final story. This one involves private capital, and they're going hunting for what are being called index misfits.
This is a thesis you hear from major allocators like Bruce Flatt at Brookfield. The idea is that companies that don't fit cleanly into the big indices, the S&P 500, the MSCI, are often undervalued and underowned by public investors.
Why do they get overlooked?
They just sort of fall through the cracks. They might be too specialized, or their sector is kind of a hybrid. And since the big index funds can't easily buy them, they miss out on all that passive capital flow that props up the giants.
Which creates a value opportunity for private money.
A huge one. And the timing is key.
Why is private capital leaning in right now?
Two big reasons. First, public valuations for things like infrastructure and specialist REITs have come down. And second, credit spreads are tight.
Okay, hold on. Let's define that. What does tight credit spreads mean, and why does that matter for M&A?
A tight credit spread just means the difference between the yield on safe government bonds and the yield on corporate debt is small. Basically, borrowing costs are favorable for good companies.
So it's cheap to finance a deal.
Exactly. When spreads are tight like this, private equity can finance these large acquisitions of high-quality assets very cheaply, so that index exclusion becomes like a green light for patient capital.
Market inefficiency, creating opportunity. Okay, we've covered the 5 hidden stories. Let's pivot to the forward look. What are the key data points and earnings reports that are going to shape the next few weeks?
Well, we're about to get slammed with earnings from tech and software. We'll be watching Zoom, Zscaler, Autodesk, Workday.
And what should we look for?
You need to look past the headline revenue. Focus on 3 things.
First is cash generation, obviously. What are the other 2?
Look for specifics on AI-related upsell. Is AI actually driving new revenue, or is it just, a marketing line? And third, watch how aggressively they're using share buybacks to offset their stock-based compensation.
Let's unpack that last one. It's technical, but it's so critical. Why do buybacks need to offset stock-based comp, or SBC?
So SBC is when companies pay employees with stock instead of cash. It's great for retaining talent, but when those shares vest, they increase the total number of shares out there.
Which dilutes existing shareholders.
It dilutes everyone. So management uses cash to buy back shares, a buyback specifically to soak up that new supply and keep the share count from ballooning. It prevents a drag on earnings per share.
It's a key indicator of financial discipline. Okay, moving to hardware. We've got Dell, HP, and Nutanix reporting. What are we tracking there?
This is where we get a read on how broad this AI CapEx wave really is. Is all the money just going into high-end AI servers for a few giant companies? Or is it broadening out into a real PC refresh cycle?
So we find out if the spending is spreading.
Precisely. And then finally, there's the macro data. We've got a really compressed schedule coming up.
Right before the next Fed meeting.
Exactly. We've got September retail sales, producer prices, consumer confidence, all landing right before that meeting. And because of that timing, each release has the power to dramatically shift the odds of what the Fed does next.
Which instantly moves the market.
Instantly. Every data point now carries this outsized weight.
This has been a really insightful look at the market. The final takeaway seems to be this dramatic split. The U.S. consumer is exhausted, making holiday sales growth totally reliant on margin-killing discounts. Even as the tech sector just soars on future AI optimism.
And that contrast brings us right back to that risk check. You have over $1 trillion in margin debt leveraging up into strength pitted directly against $380 billion in disciplined unallocated cash.
Leverage versus optionality.
Exactly. And while the markets feel optimistic today, that tension forces all of us to consider which of those two postures, aggressive leverage or disciplined optionality, is truly the most durable over the long term, especially when the next downturn finally arrives. That's the question you should be mulling over for your own risk exposure today.
A truly provocative thought to end on. Thank you for joining us on The Deep Dive.